Hello everyone and welcome back to my channel. In this video, I'm going to explain to you what we need to do to make $12,000 per year trading derivatives. Okay, this includes options and options on futures. Very important that you guys do understand. This is not in relation to long-term stocks and it's not in relation to cryptocurrencies that we do cover in this channel. Okay, this is just a quick let's say entry calculation simulation that I have here in this spreadsheet, and because when I'm going to press the trigger, I want to compare a few options. Okay, actually go from here, okay, to here. I want to compare a few options in terms of what I'm getting in relation to annualized return, because I don't want to press a trigger on a trade that I'm going to babysit for a little while to make 9% annualized. Why? I can just buy the index and forget. It doesn't make sense, okay? My goal, it is to make annualized roughly between 10 to 15%. Why? Because that lands, guys, on a magic number, which it is, my point of view, 12% per year, which gets you 1% per month. If you get 1% per month trading options, you're supposed to be a genius. Consider yourself a genius. And then you say to yourself, but if I make 1% of 10,000 per month, that's 1K. What can I do in my life with 1K? So the problem, it's not the 1%. The problem, like I always say, it is your account size, okay? But like here, for example, if we were to have pressed the trigger in this trade here, which was Google, for example, would have given us 33%. On this one, MTDR, 46%. Moss, we wouldn't have pressed the trigger, and these are going to show to you guys in a second what does it mean, because this is what we're going to look in relation to getting our $12,000 per year, okay? So basically, what we're going to do is we're going to do here a reverse engineering to find out what we need to do in terms of selling options to make sure that we get $12,000 per year, which is roughly $1,000 per month. Even if you do have a smaller trading account, this is, guys, perfect for you, okay? But anyway, without further ado, let's get on to the video. And we're going to do here, guys, with IWM, one of the best ETFs you can ever use when it comes to trading options. Why? First, is an ETF. Second, tracks the performance of the Russell 2000. And the Russell 2000, guys, is like this. There's not a cash cow business out there better than this. It goes up, it comes down, thank you very much, you close. It goes down, it goes up, thank you very much, you close. Goes down, goes up, you close, go down, you do this year. It's just amazing. Amazing ETF with a lot of liquidity and a lot of DTEs as well to trading options, okay? Today, IWM is trading at, I don't know if I got the stock price here. Stock price $219 and $15. Actually, this is correct, because if we go here to our TastyWorks, as you guys can see, $219 and 16 cents. Okay, of course, I'm using here, Yahoo Finance to get these values here into the spreadsheet. So basically, what we need to do is we need to put here in this cell here the number of weeks. We're gonna put here 50. Why? Let's take 2 weeks out of the equation, maybe because you know trading, you're sick, or the holidays. Let's call that 50 weeks per year. So our weekly profit, in other words, the weekly P&L required for us to make $12,000 per year is going to be $240, which is basically, guys, just these two numbers here divided by each other. That's it, okay? 12,000 divided by 50 is straightforward, $240 a week, okay? Because if you get your calculator, sir, you multiply $240 times 50, you guys gonna end up with $12,000, okay? And of course, what we're gonna do now is we have to pick a strike price that's going to get us some sort of premium, in this case here 0.71, and then from here we need to make sure that we know the number of contracts, okay? The number of contracts that we can trade, or you must trade to achieve this number here, okay? To achieve this number, 12,000. Because in this case here, we are getting 0.71. Because if we go here, for example, to TastyWorks, and then we're gonna select here a 9 DT, okay, on the 14th of October. You guys can select any DT. You can select 16, 34, 48. This is just education purpose only. In my point of view, when it comes to having a target at the very beginning, when it comes to option, maybe short term, especially nowadays, stock market trading at all-time highs, guys, the shorter the better it is, because you can get out very, very quick, okay? Anyway, if we open here the option chain, so in this case, what we're gonna do is we are going to do here one STD, okay? For those of you who doesn't have a clue what I'm talking about, it's basically, guys, just one standard deviation. That's it. That's it, okay? We're gonna base our strike price on one STD, which is roughly 16 deltas, okay? Why? Because we're gonna have here roughly a probability of profit of 84%, okay? 16% here each side, all right? If you put here 84, here 84. So basically we're gonna sell here roughly 16 deltas. In this case here, we're gonna pick here the $212 strike price, okay? And we're gonna have one contract with 8-9 days to expire. Of course, I'm a little bit ahead of you guys, probably in the US, something like that. We're gonna collect here, if I press the mid price here, we're gonna collect here 71 cents, which is the maximum profit of $71 multiplied here by our usual option multiplier. And our maximum loss is gonna be this number here if the stock goes to 0, and this is gonna be the buying power required for us to open this trade. As you guys can see, although this is a very good, let's say, analysis for a small trading account when it comes to trading option, you at least have to have, guys, a few thousands on your account. Otherwise, it's almost impossible to trade options. It's not even worth. Just buy something and hold long term, okay? Anyway, so going back here to our analysis. So in this case, we got here 71 cents. We got the 71 here. Let me go back here. We got our 71 here dollars because we multiply this thing here by 100. Okay, so our strike price was $212, and this requires us to open 3 contracts. This is automatically calculated, as you guys can see. So basically, it is the weekly P&L required for us to trade divided by the premium of the strike price. So this tells us that we have to sell at least, in this case here, let me go back here. At least we need to sell here at least 3 contracts for us to achieve this 240. Very, very simple, okay? And of course, this has been round up, because if you don't do the Excel formula right, it's gonna go 2.8, 2.9, and it's gonna mislead a little bit. So when you multiply it by the contract number, you have to do this thing here, rounding up, okay? Always round up. It's better more than less, okay? So in this case here, 3 contracts, and then our assignment cost is gonna be this number here. Why? I'll show you guys why in a second. Because if I go here, let me see if I can go back here. Let me go back here. 63721. Let me see if it makes sense here, guys. So we got here a $212 strike price, 71 cents. Okay, so I'm gonna put here $10,000 maybe. 63.87. Okay, that's make easy, but let's go back to 12,000. Okay, so yeah, so basically this is our assignment cost. Okay, what doesn't mean is, one sec, guys, let me just make these cells to look the same, because otherwise it's just gonna mess up with our simulation here. So basically this means this is our maximum loss. Okay, very, very simple. Our maximum loss here is going to be our strike price of 212 minus this premium here, okay, times our number of contracts, in this case here, this thing here, okay, which is number of contract, okay, and then times 100. Okay, so this is our maximum loss. Very simple calculation, very, very simple. And in terms of buying power, normally the brokers charge you, depend the broker. Some broker charge 15%, some broker charge 15% on margin accounts, portfolio margin. I'm using here roughly 20%, as you guys can see, okay? Is it 12 or 25? Let me see. Let me go back here. Yeah, 20%, okay? I'm using here 20%, but you can put here as a cash account. It's up to you. This is just the portfolio margin. It doesn't matter because we're not calculating here other stuff. The only thing we're calculating here, it is this thing here, okay? We're going to use the date of today, the stock price. Let me put a little bit less here. The stock price, the ticker symbol is IWM. The stock price, the strike price, 212. That's our premium collect, 71 cents per contract, expire on 14, okay? So our break even, I'm talking about these things here, guys, okay? If you pay attention, okay? So our break even, 211, which give us a downside cushion or protection of 3.6%. In this case here, we're selling one contract. We're doing this thing manually, but you can do it three like we do above. It doesn't matter. It doesn't make difference. $71, 8 days to expiration. Rate of return on cost, 34%. Premium per day, $8.90. And then the purchase price, $21,200, which is the strike price times 100. And what else? 15.3 annualized. Thank you very much. We are good to go. Okay, this passed the test, which is being above 50%. Just passed the test. So we will be trading here this strike price. Okay, just make sure you get enough annualized return, because although you're still achieving here your goals of capturing $240 per week, you need to make sure the strike price also pass the test of your desired or required inputs when it comes to trade cash security put options. Because everything has to be, guys, annualized, okay? Annualized to see how much percent you're getting. In my case, I want to get 15 at least, okay? So this is very, very simple. So in this case, this will be good enough for us. If you can repeat this every 90 days for the whole year, we will end up, guys, making enough a weekly, and then in this case here, achieving our weekly requirements here and making this money here, which it is $12,000. Very, very simple. So basically, you start with your desired amount. You put how many weeks you're going to trade per year, and then you divide. That's how much you need to pull a week. And if you sell options here, although this one here, it is 8 days to expiration, like you guys can see down here. Okay, 8 days down here. But you can sell this for 7 days, 6 days, and so on. It doesn't make difference. You can put 14 days and so on. It doesn't need to be like exactly 7 days. This for you guys to have an idea or a ballpark idea how much you need to capture in terms of premium to meet this desired outcome, which it is $12,000 per year. You can also change this thing here, let's say for 10,000, okay? As you guys can see, it changed a little bit because now, actually, let me go back here. Now we don't need any more. $240 per week. Now we need only 200. And look at our maximum loss. It's only now 63,000. When way lower than we had before, $12,000. Number of contracts still the same, and so on. Okay, you can play around with things like this to have an idea, or to have at least a ballpark what sort of number or amount of premium you must collect on a weekly basis to achieve this number here. And of course, from here, you can expand and you can say to yourself, how much 30K do I need a weekly? Okay, a weekly to achieve this goal. I need to make sure that I have here $200 or 30K every single week. Okay, like I said to you guys, your options can be 8 days or 9 days, 14 days. You can have like one trade here on IWM with the 14 days to expiration, one on SPY for 10 days, one on Ford for 7 days, one on Triple Q for 30 days. But in general, you need to have here at least $200 of time decay every single week to meet this requirement here of $200, which is going to end up giving you $10,000 per year. It's pretty much a reverse engineering when it comes to trading options, okay? And for those of you that have asked me these numbers here, this is just what happened, guys, last week. This was the outcome, okay? IWM went down 1.4%. The VIX dropped quite a lot because the market did recover a little bit. The Nasdaq went up 1.2%, Dow Jones 0.8%, and then the S&P 500 went up roughly 1%. This is just for me to have an idea and what's going on, okay? And of course, inside this thing here, like I always say to you guys, you also need to make sure you manipulate your position size according to the risk you want to take per trade. And of course, guys, again, like I always repeat, position size is the king, okay? Nevertheless, this is, guys, a very simple, let's say, exercise or reverse engineering when it comes to how much premium or 30k you need on a weekly basis to achieve your goals on a yearly basis. But it is very, very effective because you can manipulate these numbers around, you can simulate this thing in different ways, but at least you can have an idea how much you need to capture in terms of premium as an option seller to achieve your goals. The only thing we cannot do is to achieve our weekly premium but mess up with our position size. So position size first and then making sure we can capture this, because if not, what we need to do is we need to lower this number here. Unfortunately, that's the way it goes. As you guys can see, when from let me see here. Went from 3 contracts down to 1. It is what it is. Okay, so it goes position size and then the number of contracts to achieve this thing here on a weekly basis. Because as an option seller, of course, position size is the king. Guys, thank you very much. I hope this video has added some value to you guys. If you have any question whatsoever, don't forget, leave your comments below and I'll answer to you guys as soon as possible. And don't forget, for those of you that want to trade option and learn how to trade option, guys, there's a full playlist on how to trade an option on our channel from zero to hero, okay? And of course, from there, you can move yourself to more advanced contents. But everything you need to know as an option beginners, it is on that trading course, and we're gonna pretty much improve them more and more and more. And we do have other videos on this channel. You can download your trading journal, you can download how to manage cash secure put. We got also a trading journal so you can manipulate numbers around. Plenty of things, guys, you can use for free in this channel. The only way you can give something back for us, it is by leaving your comments below, subscribing to the channel, and pressing the like button. All the best, stay safe, and happy investing.